Welcome to Financial Insights in Minutes, where your time is valued as much as your investments.
Get ready to unpack the latest financial news in record time.
Today, we explore critical insights on rising market trends and expert forecasts.
Is Bitcoin ready to soar again, or are stocks headed for a bumpy ride?
Stay tuned as we summarize top videos from financial experts so you don't miss a beat. Welcome to Game of Trades. Today, we're charting the tempestuous waters of Bitcoin and its next big opportunity. Will it surge or sink in the coming months? Let's find out.
Absolutely. This episode dives into the intertwining fates of Bitcoin and the broader stock market. Buckle up. It's going to be an insightful ride.
So what's the crux of today's analysis?
The main thesis is that Bitcoin is heavily influenced by the stock market. Recent trends suggest that as stocks rise, Bitcoin may soon follow, despite some current bearish indicators.
Let's kick things off with the relationship between Google Trends and Bitcoin prices. What's the scoop?
In March 2024, searches for a crypto bull run hit an all-time high right before Bitcoin dropped 30%. It's a clear sign.
How are Bitcoin and the stock market tied together?
They move in sync. When the S&P 500 rises, Bitcoin often follows. A drop in stock markets? Well, Bitcoin typically dips too. It's like a dance between the two.
Interest rates play a huge role. What's the analysis there?
As inflation decreases, interest rates may drop. Historically, this has led to Bitcoin rallies. Think of it as a financial tide that lifts all boats.
And what about market sentiment?
Right now, a whopping 75% of S&P stocks are rising. That's broad-based optimism in the market, which often translates into Bitcoin gains.
Finally, let's chat about the technical indicators. What's the story there?
Bitcoin does sit below important moving averages right now. However, if it manages to reclaim these averages, it could lead to a significant price surge.
What predictions can we glean from this?
The potential for a Bitcoin surge is real. If the stock market rises consistently, Bitcoin is set to catch up, especially if it breaks above those moving averages.
Any more predictions on the horizon?
Yes, continued drops in interest rates should fuel Bitcoin's growth. But if recession fears creep back in, watch out. We could see declines again.
To wrap things up, what's the overarching takeaway here?
Bitcoin's future is closely linked to the stock market. Positive indicators could mean it's time to buckle up for potential gains.
What should our viewers keep an eye on moving forward?
Interest rates and overall market sentiment. Let's see how these play out for Bitcoin in the coming months.
What do you think about Bitcoin's future? Are you bullish or bearish? Drop your thoughts in the comments section below.
We want to hear from you. Your insights could spark the next big discussion.
Welcome to Thoughtful Money. Today, we're navigating the choppy waters of the stock market with our special guest, market analyst Michael Leibowitz, who's filling in for Lance Roberts. Get ready for a deep dive into the current economic landscape and what it means for your investments.
Absolutely. Michael is here to provide insights from RIA advisors armed with data-driven analysis of the markets, especially in light of recent events. Let's gear up for some cerebral navigation.
So what's the core theme from Michael's insights?
Market volatility is on the horizon as we approach the upcoming election. Without a clear frontrunner emerging, stocks are likely to be on a choppy road to nowhere.
Let's break this down. First off, what do you have on market reactions to Fed policies?
The Fed is expected to cut rates in September in response to the growing concerns in the labor market. Michael emphasizes the need to keep an eye on upcoming economic indicators.
And regarding inflation's impact, what's the scoop?
Inflation is starting to normalize around 3.5%, but consumers are feeling the pinch, leading to cautious spending habits.
Interesting. How are earnings reports shaping up?
Recent earnings reports from giants like Taggart show that growth is stalling. If consumers tighten their belts, it could spell trouble for the broader economy.
What about consumer confidence? Is there reason for concern?
Absolutely. Surveys indicate a decline in confidence, with people increasingly worried about job security and a slowing economy.
Looking ahead, what are some predictions on how the markets will respond to the election?
Expect heightened volatility as traders try to manage risk leading into the election. A clear market direction may not emerge until results are in.
And the bond market, what's expected there?
In light of uncertainty, there may be a shift toward long-term bonds as investors search for safer havens during choppy market conditions.
So to wrap this all up, what should investors take away from today's discussion?
Be prepared for volatility as we approach the elections. Stay informed about key economic indicators and consider reevaluating portfolio strategies in light of current trends.
Any suggestions for viewers moving forward?
Absolutely. Encourage viewers to actively reassess their portfolios. Comment below on what adjustments they're considering.
Welcome to Kitco News. Today's thrilling voyage dives into market volatility. Are stocks ready for a breakdown as gold and bonds send strong signals? Joining us is the knowledgeable Chris Vermeulen, a savvy technical trader. Are you ready to unearth some financial treasures?
Absolutely. Chris has his finger on the pulse of the market and is here to help us decode these complex developments. Buckle up, viewers.
What crucial insight does Chris provide on the market? What's the heart of the matter?
The core thesis is that the Fed's indications of upcoming rate cuts have triggered significant reactions in the stock and bond markets, raising concerns about volatility and potential downturns in the future.
Let's pick apart those key points. How does the market usually react to rate cuts?
Historically, we see the stock market respond positively to rate cuts, since lower rates mean companies can manage their debt better, leading to higher share prices.
Moving on to bonds, what's the situation there?
Bonds are looking promising. Chris believes we could see a 20% rally in bond prices as they are beginning a new bullish cycle.
Gold is all the rage right now. What are the forecasts here?
Chris targets a price of $2,700 for gold, anticipating that it may reach this level within a couple of months.
What are Chris's predictions for market corrections?
He anticipates that once gold hits its target, we could see some major pullbacks in both the gold and stock markets. It's a classic case of buying the rumor and selling the news.
And what are we looking at in the short term?
Chris suggests that while short-term trends show bullish activity, a serious downturn is on the horizon.
As we wrap up, what key conclusions can we draw from Chris's insights?
Investors should brace themselves for significant market shifts. It's crucial to remain vigilant and adjust strategies as market dynamics evolve. So what are your thoughts? Drop a comment below.
What should viewers take away regarding their investments?
Staying updated with the latest trends is vital for making informed investment decisions. Keep an eye on those movements.
Last question. What do you think will happen next in the market?
That's the million-dollar question. Comment your predictions below. We want to hear from you.
Welcome to David Lin's channel. Today's in-depth discussion revolves around the current bullish market momentum. Joining us is Alex Morris, CEO of FM Investments, who brings his expertise in economic outlook and investment strategies. Let's dive right in.
Absolutely. Alex is here to shed light on the stock market rebound and the sectors he believes will outperform. His insights will guide us through the economic currents.
So, what's the main thesis of today's discussion?
The key takeaway is that the market's rebound indicates a strong upward momentum. The dip in July was more of a trading event rather than a fundamental change in the market.
Let's talk about that market momentum. What caused the recent dip?
The dip was driven by trader nerves, not by changes in fundamentals. Essentially, the market is back on its upward path.
What's the outlook for the bond market?
Lower yields suggest a bullish sentiment, but the Fed's tighter control on rates will shape the bond recovery.
It sounds like there's some wild stuff happening with stock-bond correlations. What's going on?
Historically, it's expected to see inverse correlations, but these could normalize as the market grows.
Can you break down how consumer spending is shifting?
Consumers are reallocating their spending. Luxury items are seeing a decline, while everyday essentials remain popular.
Speaking of uncertainty, how might the upcoming elections affect the market?
There could be volatility depending on the outcome, but fundamentally, the market remains focused on growth.
What predictions does Alex have for sustained progress?
He anticipates a continuation of the bull market, especially in banking and commodities, due to potential rebounds.
How does the Fed fit into these future predictions?
The Fed's gradual rate cuts will be crucial to maintain stability without triggering a recession.
To wrap things up, what's the overall outlook?
The market is poised for bullish behavior despite some fluctuations. It's essential for viewers to keep an eye on long-term sustainability.
What should investors be doing now?
Investors should adapt strategies to these shifting trends. focusing on sectors that show resilience and potential.
We want to hear from you. What are your predictions for the market considering the upcoming changes?
Exactly. Drop your thoughts in the comments. Let's start the discussion.
Welcome to Blockworks Macro, where we explore the intersection of finance and technology. With us today is the insightful Z from Split Capital, who's here to shed light on the Fed's recent easing measures and what it means for the global economy.
Z brings a wealth of knowledge on macroeconomic trends and cryptocurrency markets, which puts them in a unique position to discuss the potential impacts of these shifts. Let's dive right in.
So what's the crux of today's discussion? What does this easing cycle mean for us?
The core thesis is quite clear. The Fed and global banks are shifting into an easing mode, which typically indicates mounting liquidity entering the markets. This raises questions about potential credit crises, yet hints at a thriving investment environment.
Let's break down some key points. What are the implications of the Fed easing?
The Fed's easing often leads to increased inflows into bonds and equities, suggesting that liquidity will remain abundant. Also, it's interesting to note that all global banks are easing together, which is a significant indicator.
And how have the markets reacted to all this?
Markets showed a positive response to Powell's dovish comments, signaling optimism. Additionally, with inflation remaining in check, this offers room for further easing.
What about consumer behavior in light of these changes?
We're witnessing a renewed interest in the housing market recently, likely because of easing cycle perceptions. Although venture capital shows distress, there are inklings of improvement.
Now let's discuss predictions. What can we expect moving forward?
Expect a continued cycle of liquidity. As long as the Fed maintains these easing policies, inflows into equities and bonds should surge, potentially leading to a soft landing for the economy.
What about the future of credit markets?
If any significant credit issues arise, we could see tightening. Investors must keep their eyes peeled on the labor market, as it may trigger policy changes.
To wrap up, what are the key takeaways for our audience?
Investors should focus on monitoring the Fed's actions closely and the behavior of the labor market to gauge future directions for their investments. Everyone, keep your conversations and predictions coming in the comments.
So, turbulent waters ahead, but potential opportunities.
Absolutely. There's always a silver lining. It's about navigating through wisely.
What strategies will you adopt considering these uncertain economic signals?
We'd love to hear your thoughts. Drop a comment below.
Welcome back to Markets Weekly. Today is August 24th, and we've got some intriguing developments in the market waters.
Indeed. It's been a week where the major indices hover just below all-time highs, keeping everyone guessing. What are we diving into today?
What's the core message we're taking away from this week's updates?
Today, we explore how Chair Powell's pivot at Jackson Hole suggests imminent rate cuts, alongside a significant downward revision in U.S. jobs, hinting at an economic crossroads.
Let's navigate to our first key point. What's happening in monetary policy?
Chair Powell made waves at Jackson Hole, signaling that the time for rate cuts has arrived, particularly as employment fears mount.
Move on to the second topic, the dollar's performance. What's the scoop?
The U.S. dollar has been on a weakening trend, even with interest rates cutting broadly across the globe, raising questions about currency dynamics.
And what about the job market news? Lay it on us.
The recent downward revision where jobs created were overestimated by a whopping 800,000 has sent shockwaves through the economic forecasts.
Let's talk predictions. What's on the horizon in terms of rate cuts?
Rate cuts are likely coming in September, heavily depending on if the unemployment rate stabilizes or jumps higher.
And what about the dollar? Is it smooth sailing or rocky waters ahead?
If the dollar continues its decline, it could lead to a fire sale in U.S. assets as foreign investors react to currency losses.
So, what's the bottom line for this week?
The stage is set for possible rate cuts and a deeper look into our job markets. Everyone should stay alert.
Any final words for our viewers regarding the job data?
Absolutely. The reaction from the markets suggests that job data revisions are taken lightly unless they impact current trends. Keep watching.
What should viewers do with this information?
The best approach is to comment below with your thoughts. What's your take on these changes?
Welcome to NorthmanTrader. Today's focus, Is the market really running toward the light or just chasing shadows? We've got Sven Henrich, a veteran market analyst, spilling the tea on what's brewing in the market.
Indeed, it seems like Sven's got some juicy insights. He'll unpack the recent market exuberance and the implications of the Fed's potential rate cuts.
Let's get straight to the thesis. What's the buzz here about the Fed's pivot?
The core thesis highlights that the Fed's promise of rate cuts is fueling market enthusiasm. Yet, this optimism is tempered by caution rooted in historical trends, especially concerning recessions.
Now, let's navigate through some key points. What's going on with market enthusiasm?
The Fed's pivot to cutting rates is sending the market soaring. We're seeing a lot of excitement as we're close to all-time highs.
But isn't there a catch here?
Absolutely. This excitement is reminiscent of 2007, where initial relief turned into a downturn. History shows that yield relief can easily lead to pullbacks.
What about the technical side of things?
Currently, we've seen oversold conditions that have improved. Key resistance levels are being tested, which could determine the next market moves.
What's on the horizon then?
The Fed's September meeting could be a game changer. Additionally, traditional seasonal trends in September and October signal potential market volatility.
And what about the predictions? What should we be mindful of?
Predictions indicate possible weaknesses in the market between September and October. We could see a break of resistance before potentially rolling back.
So, is there any silver lining here?
Sure, if resistance is broken, we could see new highs. The bullish sentiment heavily relies on forthcoming economic reports.
In wrapping up our discussion, what's the final takeaway?
Stay vigilant. As Sven highlighted, while optimism is high, historical signals and technical indicators suggest that caution is necessary. What are your thoughts on the market's next move? Drop your predictions in the comments.
Definitely sounds like a market to watch carefully.
Indeed, historical patterns remind us not to get swept away by euphoria. What do you think will happen? Will we break the highs or will the market pull back?
Welcome to CiovaccoCapital on YouTube. Today we're setting sail on a review of the latest market charts to explore the question, are the charts drifting away from the soft landing bull market script? Buckle up because we're diving deep.
Absolutely. With Chair Powell signaling rate cuts, it's crucial to analyze how this affects market trends. Chris Ciovacco will take us through it all, backed by his extensive experience in market analysis.
So, what's the primary thesis from today's discussion?
The core thesis suggests that even amidst fears of a recession, charts reveal a strong bullish sentiment as the Fed prepares to cut rates, indicating institutions are confident in stock accumulation.
Let's break down the first key point. Market reactions to Fed signals. What's the scoop?
On August 23rd, a staggering 92% of trading volume was associated with advancing stocks. This is a clear signal that institutions are buying, downplaying recession worries.
Interesting. What do historical comparisons show us?
The current charts are closely mirroring the market dynamics of 1995. Historically, after the Fed cut rates, the market often thrived, setting up a strong performance trajectory.
Now, how are different sectors performing?
We're seeing marked improvements in sectors like technology and finance, while the energy sector is showing notable resilience. This broad-based strength is encouraging.
Time for some predictions. What's on the horizon?
Considering the current dynamics, it's likely that increased institutional buying will continue to push prices higher, fostering an extended bullish trend ahead.
Any thoughts on how sectors might rotate?
There's potential for defensive sectors to gain momentum. Investors often migrate to safer assets during times of volatility, so this could shape future market trends.
Wrapping it all up, what are the big takeaways?
The charts present a clear bullish signal despite underlying recession concerns. There's a notable potential for continued market rallies, urging investors to stay informed and ready to navigate these waters.
What do you think? Are we truly avoiding a recession?
Drop your thoughts in the comments below. Let's hear how you navigate these market currents.
In summary, our guests have varied yet insightful takes on the current financial landscape.
Chris emphasizes gold's potential rally, while Alex remains bullish on stocks despite some volatility.
Z warns of potential credit issues amid global easing, contrasting some of the optimism.
The overarching theme remains clear. Adaptability is key in this dynamic market.
Thanks for watching Financial Insights in Minutes, for August 24th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.